And 72% of the time the market goes up. And the answer came to me. And that's when I developed my chart. The answer came to me is because, just like Caterpillar, when they pull their money out, you get out. Whoa.
It's your daily dose of how to manage your money. And now it's time for Phil's Gang on the Off the Wall Street Network.
Oh, God. I get nuts.
With your host, Phil Grande.
And welcome to my podcast. Okay, so the market today again, if we take a look, it's having a little trouble. And the reason why is because yields, let's take a look at the 10-year yield. 10-year yield is going back up again. Remember, it's really important that these yields keep dropping because this is a relief rally, a temporary rally. And more people get hurt in these kind of rallies than anything else because they don't understand what a relief rally is or a temporary rally. They think, oh, gee, the market's going up and this is terrific. I'm going to get rich. I'm going to buy all these stocks at a low price, especially tech stocks. And they pile in. They don't have a clue that this thing can blow up any time because it's a relief rally. It's a temporary rally because the reason the rally is going up, what fuels it is all the shorts. So everybody's been shorting, now buy their stocks back. That fuels the market go up. But when everybody finishes buying their own stock back, the fuel stops. Now, if you don't have the institutional money behind you, then the market turns around and just starts going down. And that's what people don't understand, especially if they're buying stocks at the peak. So let's say a stock was at 80 and now it's at 150 and they're buying it right at the top, the FOMOs. They have no idea that once all the shorts buy their stocks back, there's no more. They have no more money to do it. The rally stops dead. And unless you got the big institutions coming in and buying big, and how do they buy big? They take their money out of investment grade treasuries and 10-year treasury yields, and they take that money and they buy stocks. But they're not doing that. Why would they? Because interest rates are too high. They want to get interest rates before they come into the market. They want interest rates around 3.9, maybe 4. So we're at 4. Let's see what we're at. 4.30. See, they've already gone up again. That's a problem when they're going up. And if you're in a relief rally and you think, oh, this is good, I'm going to jump in and buy a tech stock now and it's going to go way up again, and you see the yields turn around, instead of heading down towards 4 or 3.9, they're heading back up. The market's going to, it's going to go negative. You're going to lose money. So people have no idea what relief rallies are, and they're the ones, the relief rallies hurt the most because it's a sucker's, or I shouldn't say sucker, it's a head fake rally is what it is. So now the other problem is that if you have the yields, IWM, let's talk about IWM, SPY, and the Qs. Now, if you're trading in a market, a relief rally market, you got to keep your eye on that treasury yield, right? Because if it starts heading up, you lose money. They're going to sell. You also got to keep your eye on the 3 indices because the Qs, the spiders, IWM, if they're green, that means it's still okay. The market's still okay. But what happens is yields will first tell you if a market's going to stop rallying. And IWM confirms it. So when the yields, all of a sudden, when the yields start, your market's going up, yields start heading up instead of down, then that's telling you we could have a correction or a crash. And then IWM, they look and all of a sudden they start rolling over, and Qs and the spiders don't. That's confirming it. So these relief rallies are temporary, and they can be very dangerous unless you really know what you're doing. Now, you can make good money on relief rallies because it's emotional. And when people short stocks, and every time Trump comes out and says, "Oh, we got a great deal with Iran. Everything's wonderful with Iran. We're going to extend 10 days." Oh, people get relieved. Oh, that means oil's going to come down. That means gasoline's going to come down. I better buy some stock. But they don't understand that can change in a split second. So yields are a truth serum. Yields, I always tell you, it will always tell you what's going on with the market, what direction it's going. If yields are heading up to 4.75 from where we are now, 4.30, your market's not gonna, it's gonna start cratering. It's gonna go down. Okay, if yields start heading down, that means the market's gonna get better. And what we need IWM for, we gotta watch IWM because they are the strength of our whole economy. They measure the economy. So as long as IWM, okay, is strong, and then as long as it's staying up with SPY and the Qs, that's great. We're all in good shape. Now, yesterday what happened was we had this big rally. Everybody was all excited. Oh, wow, look at this rally. We're up 375 points. Well, what they didn't talk about, yeah, we're up 375 points. And again, up 375, and three stocks drove that rally. Just three. So think about it. We were up 375, we're up 375 points on the S&P, and we're up, I think 375 points on the NASDAQ. We're up 55 points on the S&P because we had three stocks driving all that rally. Are you kidding me? We just three stocks. So we had, again, Google, we had Nvidia, we had Amazon. So everybody's going, "Oh, wow, this is wonderful. Look at the money I'm making." They have no idea. They have no idea that rally, if you think about, they control about, those three stocks control about 33% of the NASDAQ 100. 33%. So you got three stocks that are controlling everything. I mean, that's just really, it gets really dangerous. So we'll see what happens with this rally. I'm looking for a number I had for you here, if I can find it. It was quite interesting. Let's see if I can find the numbers I had here this morning. So my point is, though, you just got to be very, very careful what's going on. And the breadth is really, really bad in this market. Terrible breadth in this market. You got a handful of stocks holding up the whole stock market. And you need to have at least 75% of the S&P green so this market doesn't correct. So, and then you got to get oil down to about $75. And if I can find those numbers, that would make me very happy because there were some really good numbers. Let's see if I can find them here. I had them this morning for you. Yeah, I think I got them right here. Yeah, okay. So, yeah, the NASDAQ, let's see. Yeah, we had yesterday. All right, so Google, Nvidia, and Amazon, I have the numbers here, of that NASDAQ 100, they control 33% of that group. That's incredible. 33%. And they have, oh, here we got it. Okay. Google, Nvidia, and Amazon, they make up 65% of the NASDAQ 100. That's the number I was trying to find. Isn't that amazing? So you got three stocks, Google, Nvidia, and Amazon, that makes up 65% of the NASDAQ 100. That's insane. It makes up 38% of the S&P. So yesterday with the market rally, 375 points and 55 points, people don't realize what bad breath we have. Horrible, narrow breath. So you got three stocks. Think about that. You got three stocks, Google, Nvidia, and Amazon. They moved the NASDAQ 376 points. They moved the S&P 55 points. You got to be crazy. So what does that identify? It identifies that we have narrow breath. It identifies that the market we're in right now, this relief rally, is very, very, very fragile. Very fragile. And people are trading it like it's a regular market, like it's a bull market. And they don't have no idea. And the weakness in this market is being masked. Just three stocks. That's just insane. So if you, and the other problem that's happening is this. If you get into these stocks and you're buying them at the top, let's say they went from 100 to 200 to top, and if your stochastics are right at the top and the shorts finished covering, there's no more money to push the market up. You want to make sure you're not buying when the stochastics are at the top, because that means you're buying late. You want to be buying early when the stochastics are at the bottom. You're taking a big risk when you're buying when they're at the top. That's crazy. But just again, it's hard to believe, but you're getting three stocks that are just. I mean, how can three stocks create 38% of the S&P and 65% of the NASDAQ 100? So again, we have a very not dangerous market. Well, it's dangerous if you don't know what you're doing. That's for sure. So again, from a scale from 1 to 10, we need to get this yield back down to 3.9 or to 4. Even 4 would be fine. And then all that money the institutions have, they would take that money out of investment grade bonds and they'd be buying stocks. So what do we need for them to take their money out of the bond market and put it into the stock market? Well, we need, as I said, we need to have the rally, the yields dropping at least to 3.9. So, but that's about a 1 in 10 chance. Out of let's say out of 1 to 10 in difficulty, that's a 7. That's a 7. Think about that, because we need for this to happen a major CPI or PCI miss. So what I'm saying right now is that if people are jumping in this market thinking everything's okay again and treating it like a bull rally, they're going to get caught. Because again, for them to come in after the shorts are done, finished, if we need their money, we need new money. We need new institutional money to keep pushing this market up. For that to occur, on a scale from 1 to 10, we're at a 7. Why is it so bad? Because we have to have a major CPI or PCE miss, a weak jobs number. We gotta have jobs. Well, we're going to come in with 200,000 jobs. And under 100,000, we need a number under 100,000, and then we need foreign buyers to step in. So think about it. We need the CPI or PCE to miss. We need weak jobs number under 100,000. We need foreign buyers to step in, and the chances of that is almost slim to none. The other thing that's going on is that the government, the Fed, they're putting another 40 billion, I think about 40 billion a day they're putting in, 40 billion a month. Their deficits are so bad. Their deficits are now at 150 billion a month. 150 billion a month. So what they're doing is they're trying to sell, they're out there selling T-bills to keep the banks going because the deficits are so bad. I mean, think about that. Not about 150 billion or 90 billion a month to cover it. So you got to really know what you're doing when you're trading in a rally like this. Let me help you. Phil's Gang.